Hey, what's going on, cash flow hackers? It's Chris, Life 180. This video is going to be focused on the consumer price index numbers, the fact that the numbers were just released, new inflation results month over the month. It's going to be interesting to see how the Fed responds to it. Before I get into, I've got the report right here. Before I get into that, what I want to talk about is like what's been going on a little bit in the economy. Jerome Powell, the chairman of the Fed, has been raising rates on a monthly basis pretty much, trying to counter inflation. This has just been a constant theme that I've been talking about, the fact that inflation is higher than the cost of borrowing. And as long as the federal funds rate remains lower than the actual rate of inflation, that means there's going to be kind of like a negative arbitrage there, right? Like there's going to be, it's basically like free money. The cost of money is cheaper than the rate of inflation. Therefore, there's always an incentive to keep borrowing, keep it going, because you can access assets if you utilize debt in an investment sort of fashion. You can access that cheaper than inflation is going. So if you're buying real estate or hard assets, those are inflating typically at a higher rate than you're paying. And so that's just a way to create wealth. Now, the problem is that can turn on a dime at any point in time if we hit a recession or a potential depression. So there is risk in over leveraging with that. However, we are in a situation right now that I think, Jerome Powell is kind of faced with this decision. Okay, we have inflation here, we have the economy on one side, and then inflation on the other, right? And so the economy and the jobs market, and when I say the economy, I'm really talking about the stock market, really, at the end of the day. So the market is coming down, jobs are staying relatively strong, even though they're weakening, and inflation is not getting reined under control. Those numbers are staying higher than we've seen in 40 plus years, right? And so one of the things that we need to do is take a look at Jerome Powell, and a lot of people think he's going to retrace, that he's going to try to sustain the market, or the stock market, and try to retrace his policy on increasing rates, go back to cheap monetary policy, stop buying the mortgage-backed securities, stop buying bonds, stop or go back to lower rates, like reduce the federal funds rate to inject more money into the economy and make borrowing cheaper. But the bottom line is you have to understand the purpose of the Federal Reserve. Their first and foremost purpose is to preserve the quality, the integrity of the US dollar. Inflation is the greatest threat to destroying that integrity of the dollar. This report right here is what shows that, right? This report is the inflation report, and if we have high inflation, that means Jerome Powell is losing the battle. And so he has to keep raising rates, and it's this constant balancing act. He doesn't care about the stock market. He doesn't care about the job market. Now, he cares about them from the context that they are indicators. They're metrics that he has to look at that have an impact on inflation. Let's face it, if the job market, the unemployment rate goes through the roof, it's going to have a downward effect on inflation. If the stock market goes way down, consumer confidence is going to drop. It's going to have a negative impact on inflation. But for Jerome Powell, that's actually kind of a positive thing. So this is why I've been telling everybody, we're going to hit a recession here, one way or the other. Jerome Powell's either going to force us into it, or he's not going to do enough. Inflation's going to persist for long enough. That's going to impact every household in America. Your average middle income household is not going to have the money and the purchasing power they used to. That's going to in turn impact their buying behavior and their buying decisions, which will in turn eventually bring inflation down, simply because we just can't keep up. So we stop spending money, and that in turn will lead to a recession. And so there's no way out of this. There is no safe landing. So what I want to do for this, though, this isn't overly complicated. I want to break this down and make it as simple as possible. So let's take a look at this. One of the things that I'm going to let you know is that I'm going to focus solely right now on energy. And here's why. Because when we look at this, let's just look. These are the September numbers. You can look year over year. So you can see September 21, and this is September 22. So we had a 4 percentage point uptick compared to inflation last year. Now, here's what I want to show you here. We can see May, June were huge numbers, 1 and 1.3. So remember, the federal funds, the Federal Reserve's target inflation rate annually is 2.0%. That's their target annually. So with these numbers, you have to annualize them. You have to multiply them. So even 0.4, even though it's a lot better than where we were with 1.3 and 1.0 in May and June, that looks good, but this is still more than double what the Federal Reserve's target inflation rate is, right? And if you multiply 1.3 out times 12, you're looking at a big number. You're over 14%. And so you have to multiply all these numbers out. When you add all these up, that's where we get this month over month increase. Add up all these numbers, and that's what the annual rate of inflation is. That's how that number is calculated, just so you understand this. Now, here's the thing that I want to talk about. You can look here, March, April, May, June. What was going on there? Well, everything is driven by energy. Think about it this way. The cost of gas, the cost of electricity, everything goes and comes down to fossil fuels. So we have this challenging precipice right now that we're standing in, and is like this tipping point right now about where we are in the economy. And inflation's going high, and a lot of that is due to monetary policy, but we also have supply chain issues that have led to this problem. And while those supply chain issues are starting to resolve themselves a little bit, we have other issues in the oil markets with Russia, with Saudi Arabia. I just read an article that they're going to be jacking oil prices. That's going to have a negative impact on our economy because that's going to make the cost of gas more expensive, and that's going to have a negative impact on inflation rates, because the trickle-down effect of energy, when gas costs more money, think about what that does. It means every truck driver in the country that's trucking all of our goods, all the plane flights that are transporting all of our goods, Amazon delivery, just the mail person's delivery, your cost to go to the store, your cost to go to work, the farmer's ability to run tractors and produce food, to create the grains that feed the cattle, like all these things, the impact that the cost of energy has in this world is really hard to calculate. And when you realize that everything, inflation right now especially, I'm not saying this is always the case, but inflation right now is going to rise and fall, I believe, based on the direction of energy costs. And I think it actually shows what's going on, because remember, we had a little bit of reprieve with the cost of energy, with the cost of gas, everything kind of retraced, and now it's gone way back the other direction, and we're actually ticking in the way wrong direction. So let me go here. So you can see this is just the trend of inflation and the direction things are going, and you can see that it's trending up. Now it hit a peak here, and then, like I said, we had a little bit of a reprieve, but that they said here it peaked, we had a reprieve, and then it spiked again. And so now a lot of people think it's since it's lowered and flattened that it's going to be good, but I think we are heading back in the wrong direction, and that is what it is. Now, here's what I want to show you. Look at this. So if we look at this motor fuel here, gasoline, right? When we look at gasoline, I'm going to turn on my highlighter so I don't make it illegible. When we look at gasoline here, the gasoline services, right here we have 18.2% as the annual year-over-year inflation. That means gas today cost 18.2% more than it did a year ago at this time. However, when we look at this, there's the August to September, there's the June to July, and then the July to August. Actually, and there's the August to September. So June, July, and August right here. June, July, and August. Basically, those June to July, July to August, and August to September. And when you look at these numbers right here, it went negative 7.7, negative 10.6, and negative 4.9. So what I'm going to do now is that was June to July to August, and it went down and down and down. And so what's crazy is 1.3. So June, even though the cost of energy was higher, what happens with June here is there was a lag. So some of the costs of other areas still were spiked because the cost of gas in May, April, and March were so high that it had a lagging effect on prices in June. So while the cost of gasoline dropped in June, you can see that the trickle effect for July and August on inflation went down. So gas prices, energy prices drove the impact on the reduction of cost of everything else, and that kind of helped get inflation a little bit more under control. But if you look, and right now, and this report isn't going to show the whole study, because the bottom line is right now what you're seeing is you're seeing inflation on the gasoline. This drives everything. This looks like a really positive indicator. It looks like a pretty positive metric, like things are going in the right direction. But the problem is I'm doing this video right now, and the purpose that I want to share with you in this video, and I'm not going to make this more long than it needs to be. I got a couple more things that I want to show you after this, but I want to drive this point home. It's going to get worse because next month, what's going to come out? It's important to understand next month, October of last year to October of 2022, we're going to have another column right here. 0.9 is one of the top 4 worst months that we had as far as inflation goes. So that means gas, that we may have inflation drop, but we may have a significant spike. And so what happens is, remember, now we're at 8.2% inflation. That 8.2 is adding up all these numbers together, right? So now what happens if we have a 0.9 number, that number is going to stay flat, but it's actually really negative from a trending perspective of where things are going. And once we get back, we could have next month would be a really negative year, but it will actually, a negative month, but it will look flat, right? It will look like it's better than it really is, because then what happens is if we don't rein this in and if energy prices stay high, then it's just going to stack and it's going to get worse and worse and worse and worse on these numbers. And that is where the problem comes. So I think it's really key as we head into the holiday season here to track these energy prices, not make this overly complicated, and realize that this is going to have an impact across the board. And I'm going to be very, very curious to see how it impacts consumers when we hit the holiday season during Christmas time, Black Friday, stuff of this nature. And so as we see this, expect these energy prices and these gas prices to have a massively, massively, massively negative impact on everything else. And so what I want to do here, I want to see if I can find this real quick. I want to bounce around. I got to bounce around to a couple pages to find what I'm talking about. Boom, 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 boom. Negative. Appliances, TVs. No, there's no TVs there. Let's see if it's here. Yeah, right here. So it's interesting. A lot of the consumer stuff as well. What I think we're going to find, what I think we're going to see is that a lot of these elements, you could see inflation for new cars, new trucks, is back down to 10.5. Remember when this number was up to 40-something% several months ago? Those numbers have already started to tick down. Now remember, that doesn't pull the 40% inflation that we had out of the market. If there was a $10,000 used car, that $10,000 used truck or car went up to $14,000. All this means is that it's not that it went back to being $11,000. It means this 10.5% means that it's now just growing at a slower rate. When it inflates like that, until these numbers go negative, you don't pull that out. You're just compounding on top of the already significant inflationary growth that we had. And if your purchasing power, if your income, your wages don't keep up with that, it's impossible to catch up with. So what we really need for new cars is we need to really bring it back to earth for people to be able to afford, what I believe is afford those cars. We need like a negative 30 to 40 number in that category to be able to make it work. But the only way that's going to happen is ultimately a recession or a depression, or we need your wages to catch up drastically to what's going on there. And so you can see things here. All these inflation things are high, but look at this from August to September. Even though all these numbers are high, remember, higher than what the target is, you got negative numbers here, negative numbers. So that means there's a lot of indicators over the past several months, as you can see here. There's a lot of negative indicators that show things are under control, but a lot of this is because of the fact that gas prices have gone down. And I'm telling you, it's given a false sense of confidence, and it's just going to get worse. So I'm doing this to show you, just to learn how to look at this and learn how to read and look for indicators and look for patterns on the way this thing is going and the way inflation is being impacted. And my belief, what I believe, is that Jerome Powell is going to keep pressing the upward pressure on the federal funds rate, which is upward pressure. It's going to put pressure on the stock market. It's going to put pressure on the housing market, the real estate market, because it's going to jam up. It's going to drive up cost of borrowing all the way across the board. It's going to suck money out of circulation, which is going to have a negative impact on the stock market. It's going to hurt consumer confidence. It's going to do all these things. That's what he needs to do to drive down inflation. However, he's fighting a really, really rough situation with energy costs. And as much as he's trying to fight that, this is where stagflation can come in. As much as he's trying to fight that, gas prices are going to go up, and that's going to have a negative impact. It's kind of like supply with the housing market. The housing market should be lower than it is right now, but because supply is so bad, it's keeping prices more elevated than they otherwise would be. If energy prices stay higher, even if Jerome Powell is raising rates, he's going to have to do more to counter that, because as energy prices stay higher, inflation is going to stay higher than we would like it to see, because there's a trickle-down effect of that inflationary gas price trickle down, right? That's just going to happen. So anyway, that is that. So if you have any questions, comment in the comment section below. Any comments, do the same. I hope this makes sense. I hope it simplified it a little bit for you. But yeah, look forward to engaging with you. If you have any questions, you want to learn how to counter this, you want to learn how to set up and get your money out of the system and start building a long-term hedge to inflation, go ahead and text IBC. That's for Infinite Banking Concept. IBC. Text IBC to 26786. IBC to 26786, and it'll bring you to a video and a page where you can connect, and it'll give you some information that will help you figure out how to kind of fight this inflation and have more control of your money on a long-term basis. I think it's a super important thing. So anyway, hope that helps. Have a blessed, inspirational day. We'll talk soon.